Kevin here, top 100 financial advisor, two-time author, one-time bestseller, and we are here to talk about the stock market. Initially today, I wanted to talk about election stuff and what may happen with the stock market. I'm going to reschedule that and kind of move that around because we have even bigger news today, and that is the Dow Jones rose more than 160 points and erases its 2020 losses. Back in March, really February and March, coronavirus hit, everybody lost money, and we'll get into what the averages were, but everybody lost money. People were panicking. I really should have brought up my Facebook timeline and showed you how many people were complaining about how bad the stock market was and what they wanted to do. You had people selling, you had people really upset, wanting to withdraw stuff in their 401k. It was terrible. But just a few months later, the Dow Jones has gotten right back to where it was at the beginning of 2020. We know the S&P 500 did this just a few days ago. And I want to let you know what to do now and what could happen for the rest of the year, because this isn't the first time that this happened. And the market could go back and dip or continue to go up. You never actually know. But I want to make sure that you're in the right positions. So first, let's take a look at this graph here. This is from CNBC. You know, I really like CNBC. Just makes things simple. And really, you see like February, March. I mean, it was one of these days I'm gonna go back and go and screen grab those comments because people were really upset. But go back to the videos back then, and I told y'all, wait it out, invest like you normally would. Don't try and time the market. If you were investing in Microsoft or Dollar General or whatever it was that you were doing, if it was quality then, just keep on that path. Those were going to be the ones that won. And one of the phrases I kept telling you back then was those that are investing now are going to thank themselves like 10 years from now. The wealth that's going to be built in 2030 is going to be from the people who invest in 2020. You're seeing that right now. So those who continue to buy, like for example, Tesla, let's see what Tesla is right now. Just to give you an example, Tesla was down to $300 a share during that point in time, and now it's at 2,213. That is ridiculous. Now they're going to do a stock split, so this price is going to change. But as of right now, you would have got in at 300 and gotten an incredible return just in the past, what is that, 5 months or so. You can see here, talking February, March, February 900, all the way down to about about 427. So not exactly 300, but even so, picking up at 400, less than $500, and you're going up to 2,000, ridiculous. But if you are afraid and you didn't want to invest or you wanted to take your money out, which is even worse, that's what you would have just missed out on that. Now, I did not invest in Tesla. This is just one of the most egregious examples. I was more so into Netflix, Nvidia. Yeah, I mean, y'all got the videos. Y'all can go back and see what I was invested in. But it's hard to ignore. And a lot of times I'll say this too, it doesn't always happen in a span of months. Most times it takes about 18 months. And again, just because we hit it today doesn't mean that Monday is going to be different. You still got the election. You still got God knows what else is just floating around out there. But long-term investors tend to win. This is why you invest in quality stocks. This is why, most importantly, that I keep impressing upon y'all to be consistent with those investments. And when I say consistent, whether it's every month, every 2 weeks, whatever it is, you just buy quality and continue putting your money in it, because you never know, as you see with Tesla and other stocks, you never know when is the right time to do it until it's past. You actually never know when the perfect time to jump in until that time is already passed. If I could have known that Tesla was going to go up to 2,200, yeah, I would have bought it at 400. Anybody would have bought it at 400. Nobody knew that. Nobody knew beforehand that they were going to do a stock split. Now that once it was announced, might have been a good time, and we'll see where it goes after that. But the only way to really increase your chances is to be consistent. So it doesn't matter. I would have bought in August, September, October, November, and just continuously did it. And one of the ways that you guys have seen me do this with, what was it? It was on Cash App. I think it was NVIDIA, maybe Kroger, another stock that I've been telling y'all about. I have a weekly and a bi-weekly purchase, like $10 or $15, and every week it puts money in there, and over time the money starts to grow. And it's passive. I don't need to think about it. I wake up and say, "Oh my God, look! Now I have $500 invested, and it's grown to $700 or whatever." But again, it's all about being consistent. Now, here's what you need to be. I guess the word is concerned, but there is a measure of protection that you need to take right now. And I know the market is closed, so probably on Monday. Let me show you this. I'm going to pull up the whiteboard, and here we go. All right, this is the time. Right now is the time for you to rebalance. And sorry for the screen turning. Y'all know my handwriting's not great on this thing. And I can't talk and write, but this is the time for you right now to rebalance. And when I say rebalance, it means taking what you have and making sure you are in the right spots as an investor. Most people don't do this. Most people do not do this, and it hurts them when the market dips and when the market falls. I will tell you right now, the market will fall. That is not it's not a bold prediction. It's going to happen. It's just a matter of when. It could be this year. It could be 10 years from now. People have been saying the market was going to dip, going all the way back to 2008, and it did eventually, right? But the people who got caught off guard, you very rarely see it before it hits. Nobody knew that it was going to be a virus that shut down pretty much the entire economy. It was the worst GDP growth ever. Nobody saw that coming. I was thinking when it happened, oh, this is bad, but 3, 4 months, 3 weeks, it'll pass. No, that's not. No, I thought I was going to be traveling. I thought I was going to be able to go to homecoming. I thought I was going to be able to take my baby girl to see her grandparents in Oklahoma. That answer is no, right? Not what I would have planned or would have thought would have happened. Again, for your investments, it doesn't matter. You need to make sure that you're in the right spots. So what do we mean by doing that? So for example, there are a lot of people right now that are very heavy into tech, myself included. So if your investments are way up here in tech, and I'm going to say consumer goods, and this is stuff, now you got staples and we forget what they call it, consumer discretionary, so that's like shopping stuff, stuff you don't really need, and then consumer staples, meaning like soap, deodorant, stuff like that you really have to have. You could say, let's say healthcare. All right, so these are the three areas that I like, and when we say rebalance, what some people have right now, if anything, actually I'll do this. What most people have right now is this: 100% of their money is in tech, all of it. Microsoft, Nvidia, you can throw Tesla in there. I don't agree with that. But Netflix, Amazon, Google, all that stuff, 100% in tech, it will make you the most money. But if there is a dip and you saw Tesla go from 900 to 400, you're not going to be too happy with that. What you want to do is have some sort of balance to keep you even, so you're in the right places no matter what happens. And right now, those three areas are tech, consumer goods, and healthcare. So when I say rebalance, what you need to decide, and the number is going to be different for everybody. So what you need to decide is say, look, well, maybe I want instead to have, I'm making these numbers up, let's say 40% in tech, then I'll have 20% in consumer goods, that's Walmart, Costco, Dollar General stuff, and 20% here. No, it's 30 and 30. So this is, I'm just throwing names out there so you can definitely see if they fit for you. So we've got Nvidia, Netflix, you can throw Equinix in there too. So these are just first tech names that I just blurred out. So take it for what it is. You got consumer stuff. I would say stuff like Clorox, maybe definitely Walmart, Dollar General, Costco. Maybe you can throw Target in there. I'm not a huge fan of Target. Then you got healthcare. You can throw J&J, Pfizer, Moderna, maybe. And I don't know. I don't invest in Moderna. It's just I'm again just throwing names out there. Novarix, however you say it. So again, I'm not. This is not like these are my official stock. I'm just giving you stocks that are very similar that will fall into these buckets. Now, as I was saying, if you got 40% of your money in tech and you've got some consumer goods and you've got some healthcare, you're going to be relatively balanced. Now, I'm not a fan of energy. People say, well, you should invest in energy. And they're not doing so well right now, as well as a few other industries that aren't doing well right now either, like travel. Not a place I would invest. But I think these are the three areas that you need to be in. What you do not want to do is have way too much money here because this is what's doing well. And because a lot of people have invested in Tesla and Microsoft and all these others that have grown significantly, this is what happens where you started off even. You started off with 40, 30, and 30, and now the market is back. Maybe you invested in Salesforce and some other things that is way too high. That means that you need to take some of that, take some of this and put it here and put it here. That is one example of rebalancing. So take a look at the stocks that you do have. Now that we know that we are, I'm not gonna say we're out of it because we're barely there and you can see what happens, but this is the time for you to rebalance and kind of say, all right, I've done well in tech. I'm still going to keep it, but I want to make sure all of my buckets are filled. I want to make sure that I have my money in all these places because when the market dipped, yes, it was tech that did best at the end of the day, but it was really this right here. I really should have done this color. It was this area that did the best because it didn't drop nearly as bad as others because people were buying, you could throw Procter & Gamble here too, actually. People were buying toilet tissue. People were buying, fruits and groceries and all that stuff. You throw Kroger here too. I think it's KR is what they are, sorry. People were hoarding those things. And this is what was doing really, really well. It wasn't the most sexy thing in the world, but when everything was dropping, this was the area that was popping. And then once things got better, then it went back to tech, which is kind of what the story has been over the last few years. But you jumping in late to the boat, right? If you're just doing it after the fact, just like I knew that Kroger was going to be good way back in April, you want to be able to do that too. So make sure that your money is in these three buckets and not only in tech, even though, let me write this again, even though tech has been very good. Now, I would also say this is also a time for you to rebalance between your stocks that you see here and your bonds. So these are all stocks, clearly. Okay. There you go. And you want to also rebalance between those bonds. So for example, you've got stocks, it's all this stuff up here. This is terrible handwriting here. Stocks, and then you've got your bonds. Now, I'm a fan of bond ETFs, bond funds. The one that's always my go-to is BND. That's just my go-to. I really don't know 5 other ones just because they are almost all the same. They're supposed to be the brakes to my pedals. So the stocks are going to push me forward. It's going to make me the money. Bonds are going to give me the brakes. And the very easy way that I decide and know how much in stocks and how much in bonds is a rule of thumb. I do have some other things inside the Investor's Toolkit to really nail this down. But if you just want to know real quick, what you want to do is take your age minus 110. So it is 110. Do this. And this is not the most scientific method in the world. Minus 30, that gives me 80. So 80% of my money should be in stocks and 20% in bonds. All right, so now that's where I should be, right? So that means that as the market has grown though, so I could have started, and we'll do it this way, and hopefully this comes out right in terms of math. So we'll see. So I'll do in January, and put 20. All right, so in January 2020, I could have started off the year with 80% stocks. And I could have started off with the rest of it, 20% in bonds. Great, this is good. I started off the year exactly where I was supposed to be based on my age. Everything's great. But what happens is as time passes, the market went up, it went down, it went sideways, everything was crazy. And now, because I've switched out my investments, I didn't have Tesla before, now I have Tesla. I, didn't have Dollar General, now I have Dollar General. I'm just making stuff up. But because I switched out my investments during the year and the market has done what it has done, now my investments are very different, where my stocks has way outgrown what I thought it was going to be at the beginning of the year. So now I am at, let's say 90, and clearly this is not to scale. Now I'm at 90% stocks. And now my bonds are down here at 10%. Still, terrible handwriting, y'all will be all right. So now, guess what? I'm not where I'm supposed to be. I have way more risk than what I should. So I need to go back and again, take some of this and put it right back in the bonds where I should be. Again, the vast majority of investors do not do this. This is why they drop and get hurt as much as they do. If you go back and look at where was it? The map, I was gonna say the map, the graph on CNBC that I'm gonna go back to in just a second, if it will let me. Make sure I have the right tab here. Right, so you should be able, yeah, here we go. All right, so here, like this looks really, really terrible, but it's actually only stocks. It's really just the Dow 30, but in general, it's just pretty much stock. If you had stocks and bonds, this is not going to look as bad. Now, I can't tell you, you would have stopped here at the 24,000 mark, but your curve and the route that you come back actually looks a bit different than what this would, and how deep this is. And I may be able to show you this now. Let me see. I'm trying to think of let's see, there's a life cycle fund. Okay, so it's not the best example in the world. 2030 fund. So what I'm doing is looking at, we call these target date funds. It's really a whole different topic. Basically, a target date fund it has a combination of stocks and bonds, and it kind of moves as the market does and puts you in the right position. If I look at holdings, it should tell us how much is in stocks and how much is in bonds. Okay, so this is 7% bonds and 90% stocks. So not exactly what I was looking for that 80-20, but just for example, it got some bonds in it. But I want to show you how this is a bit different than if you only had stocks. So we're going to hit full screen. And our hypothesis is the dip won't be as bad. That is just a hypothesis. We will find out. It probably won't make as much because bonds don't make as much, right? That we do know. So let's hit 1 year, and I want to see. And again, this is 90% stocks, so it's really not the best indicator here. So this one, yeah, let's find one that's a little more conservative, which we can do by doing this. Life cycle. So we know that the 2030 fund, which is basically saying you're going to retire in 10 years, so you have to be a lot more conservative. This one should be a lot less aggressive. It's also going to make less money. But again, this one is, if you are 10 years from retirement, you need to be a little more conservative. So let's also look at holdings and just double check here. So this one has 30% bonds. So it should be a lot more conservative. So we are going to see, Really should hit chart, I guess. And this one, hypothesis, should be, uh, there you go. All right, so I'm gonna make this less thick here so you can really see, right? Oh, no, I don't want that. Now my other line is not there. All right, so we've got our fund here. We will add the S&P 500, which it just doesn't want to help right now. We'll change it to orange, and there you go. All right, so you can see right here, the dip isn't as bad. Yes, it still dipped. Okay, yes. But you can see that it was not as high. But again, when you have those bonds, it's kind of like a break. So you're not going to go as fast, but you're also not going to crash as hard either. So as you see, this dip isn't nearly as bad. When the market spiked in June for whatever reason, the spike wasn't as big. You didn't make as much money, but again, you're being a lot more conservative. You don't want to be really aggressive and trying to retire and you're way down here at the bottom on March 16th, not where you want to be. So again, that gives us an idea of what you need to do right now as an investor. Now, I'm not here to tell you, you need X amount in bonds and you need to go out and get this particular bond fund. I'm also not endorsing or telling you that you need this particular index fund or this particular mutual fund. What I am telling you is this is a very, very good time for you to take a step back, look at the investments you have, and put yourself in the right position. Because just because it's good now doesn't mean you're going to be in the best place or the right place moving forward and that you're the most protected. There are tons of amazing stocks out there that can make you a lot of money. You want to double your money in 2 years? Well, yeah, probably Tesla, Nvidia, and a bunch of Apple and a bunch of other stuff can get you there. That's true. But how do you protect yourself too? And as you see here, look at Walmart. Look at how the market just absolutely tanked right here in March. Walmart actually went up. Walmart actually went up. This is a part of why you want to kind of have that now and why you want to have stocks like this now so that you can give yourself a bit of a buffer. This is why y'all saw on Instagram the other day where my investments only went down 5% when the market was down 22%. Because I knew how to stay balanced and even though I have in the index funds, even though I have tech. You want to make sure that you have your stuff in the right buckets. And now is the time. You do not go and buy a fire extinguisher once the house is on fire. You ain't got time for that. You get one now. You get a seatbelt now. Don't wait until after the wreck and be like, oh, let me put my seatbelt on. Like, no, it's too late. It's way too late. You get it now because we know something is going to happen. We also know, look at Walmart, it's still solid without it, right? So that's the thing. It's kind of give you a break and protect you just a bit. As you see, Walmart kind of dipped, was a little erratic, but it ain't touched nowhere near where the overall stock market was. So this is why you want to rebalance. This is why you want to take the time to do it now. Now the market is up, everything is, quote unquote, okay for the time being in terms of investments. It's that point in time. So you want to go through and rebalance and take the time to say, look, I've got all of these investments. What sector, what buckets do they fall into? And how do I make sure that I have enough of these buckets out there? These are just my 3. You can have whatever buckets you want to have. You can make them all even. That's completely up to you. Okay. So I'm not, everybody's got their own objectives, their age, their risk. People are retiring in like 5 years. Your goals are going to be different than mine, but these are my 3 areas that I like. These are some of the stocks that fall into those areas, and you can decide which ones you like, which ones you don't like. But this is the time. I'm telling you right now. It may not happen today. It may not happen for another 5 years. Hopefully it doesn't. Either way, you want to make sure that you are balanced and that you have your money in each of these buckets. Because when it happens, you're going to be looking real crazy and hoping that you had, Walmart, Dollar General, Johnson & Johnson, Moderna, whatever. We know tech is good. That's why I got 40% of it, right? If I have more of my money in tech than anywhere else. But you also need to have your money in those other buckets. These percentages can be different too. You can have 50, 25, and 25, whatever. You can have, 95 and 5. I don't care. but you just need to make sure that you have those additional buckets. All right, that is it for me. You got any other questions? Feel free to add those. Make sure that you share. I really wish I said that at the beginning of the video, but make sure that you share the video. Also, make sure that you check out the Investors Toolkit. Those prices do change on the first. They change on the first. So this is one of your last opportunities to go ahead and get that now. We are going to add options into the course. If you've already been in the course, you already know that it'll be added for you for free. So this is your chance to get it now before it goes up. I think it goes up to $9.97 $9.97 beginning on the first. So this is your opportunity. Also, and I mentioned talking about this earlier, the average average investor lost $22,000. That includes their 401k. $22,000 what they lost in the last recession, which was a coronavirus, at least at this point in time. You didn't have to do that. As you see with investments like Walmart and others, stuff I've been on the record telling people about way back in March and April, you didn't have to lose 22,000. You could have cut that in half, maybe even more, by having the knowledge that we have here. That difference in what actually happened, how much money people lost versus what myself and my students did, that's like a $17,000 difference. That's, I don't like losing money, and neither do you. So this is an opportunity for you to check it out. Y'all saw students yesterday, was like, it's definitely worth it. So make sure that you get it. Again, buildingbread.com/tools. That link will be above. And that is it for me. I will see y'all on Monday. If you have any other questions or any other suggested topics, let me know. All right, that's it for me, and I will see y'all later.